Welcome back to the Data Driven Real Estate Podcast, the podcast for real estate professionals dedicated to driving business using data. I'm Mayor Norris, along with Sean O'Toole with PropertyRadar, and welcome to episode 42. This week, we have Tommy Christy. He is CEO of Alpine Holdings, Inc. and owner of ilovehouses.com, an acquisition company nationwide who buys through digital advertising and online media platforms. Tommy has over a decade's worth of real estate experience, $500 million in investment activity, and even acquired, renovated, and leased over 2,700 homes as part of Invitation Homes back in the day. He's also done over 1,000 foreclosures and distress flips personally. So Tommy, welcome to the show.
Thanks for having me.
And you still, after all of that, you still love houses. That's amazing.
I adore them. They make me happy. I love rentals and I love houses.
I sort of want to, what's interesting is I've talked more about the invitation home sector over the last couple years than I thought I would. There's a lot of misconceptions of what they did in the market at the time. I know a lot of Main Street real estate investors. We were going to the courthouse steps and we're very upset with you guys because you guys were buying under a very different formula that we could do on Main Street. Can we talk a little bit about that experience and how you even ended up there?
Yeah, for 1 second, I just want to back up because we have lots of people out there watching. Like most people don't know who Invitation Homes is or why it was important or the impact they had during the foreclosure crisis. So let's start with that, if you don't mind, Tommy.
Yeah, no problem. Starting there, Invitation Homes was, a player in the institutional space of trying to create what multifamily had institutionalized and the single family world. So, Waypoint, American Homes for Rent. There was quite a few players there that ultimately saw a clear opportunity, and that opportunity could be quantified as, high yield rent. The multifamily became very, very scheduled. Like you can take stuff down to a LA 4 cap, because they know nothing really changes inside. You got maintenance schedule, you have everything inside your lending. Single family never had that. It was a very, very sparse, separated markets. So I think Buffett first said it. He said, hey, if I could buy 100,000 houses right now, I would. And that sparked just enough of the people who have that kind of money to say, how do we organize talent and how do we organize a model and institutionalize that? And there was a lot of fear behind that, and there was a lot of excitement behind that. And out of Invitation Homes being funded by the largest private equity firm in the world, it's kind of like an easy target kind of approach to it. Like they were like, a lot of articles were written about Invitation Homes, when in reality, it was more about an industry. So they created, there's a single family rental industry as it is. And that is really what quantifies Invitation Homes is how can we build, manage, maintain, and organize and capitalize on this opportunity, which was the 2008 recession.
Yeah, and that didn't exist, right? Like large scale ownership of single family homes as rentals, as an asset class for institutional investors did not exist before that.
No.
So you got to be right in the front lines of that.
Yeah, out of fear.
Let's go back to, how you got started in the business before, and then how you got that invitation.
Great point. So 2002, I got a job selling coupons out of college in a management training program. And then I learned how to knock on doors, and that added a lot of value to sales and the generality of how personal real estate is. And then I was picked up by a local foreclosure company to do that, essentially set appointments for people who understood what they needed to do once they got the appointment. And so fast forward into 2008, I had begun doing my own buy, fix, and sell stuff. And I was on a list of people, really doing enough volume that they could be recommended by Fidelity National Title Company. Fidelity was the major title provider for the Invitation Homes model at that time. And all those powers that be said, I'll refer you to the people I think that could really help you guys build this. And I was on that list with Daniel Claiborne. And the two of us interviewed for it. I think there was probably at least 5 of us that had done that. And they were looking
in
for
the Sacramento region
in Northern California. Great point.
Northern California. Okay.
And the Bay Area was its own region. Sacramento was its own region. But at the time, they had already were driving. It was like, flying the plane while you're building it. So the immediate need to place capital was just so evident. Like they were like, we have to get product inside of this buy box. And I think that's where you started, Aaron, was like how and why is that nobody's going to build a home for $80 a square foot, including all impact fees and all of the horizontal infrastructure. You don't go vertical in Southern California, Northern California, or some of these other markets. So we were buying assets under the replacement cost, easily financed, and the demand for rental housing was shooting straight up. So 3 easy factors there. And they basically said, and it actually was less about me. It was like, can I not lose my money in Northern California? Like that was almost like the angle of, because everybody got hurt in 08. It doesn't matter what level you were at. You got hurt one way or another. And then you bounce back, so I think there was a fear part of that. I saw Waypoint was a great company and they were building before we were. And I got scared. I'm like, Blackstone's coming and I'm going to be out of business. So we worked it out and it was way better, bigger, and different than I ever had anticipated.
What channels were you buying in? It was foreclosures, trustee sale. Would you buy anything in any channel?
Yeah, so that's a really great question. I had immediate I had an immediate ability to take down the trustee sale files. I think that's what really appealed them. I had people in 5 counties. Some guy started a program called PropertyRadar and leveled the field. And I had, now everybody was there because data was so available. And I looked at it from, they were swimming in a pool that I was not. I was not buying 1990 or newer stuccos, tile roofs. Like the easy ones were going to people that were better financed than I was. I was doing, rurals or fixers and, dirty title stuff, anything, but our volume was high. So in 2009 and 10, we were into Vegas, Phoenix, California. We were able to place capital relatively competitively, like meaning the margins were still very reasonable before they had compressed. And so when they said, can you get us product? Is there stock in the market? And the answer was yes. So we were locking up short sales. People were closing on short sales, that were 6 months and the market was advancing. And they would close like 200. We would close at like 250. And then we'd be so afraid that someone's going to write an article about how 7 days later, we're paying $50,000 more for a short sale that took 6 months to negotiate. Very PR unfriendly, for us, like we're overpaying for something when reality, like where we started at $80 a foot, we are not overpaying for this product right now,
Well, having competed against the likes of you on the trustee sales side, a lot of local Main Street investors were scratching their heads like, these guys are going to get hosed. They don't know what they're doing.
Yeah.
Pissing everybody off because your formula was so different because, at one time we had to calculate how much it was going to go down in the amount of time that it took us to rehab and flip the property. So that's a really weird formula. It's not like
great point.
70% minus repairs. Oh yeah. And every month the price is going to go down 3%.
That is so, it's very relative. And I think that's what changed for me. I spent investor management is at least 15% of any flip business. You're like, let's just say a deal came through. How am I going to finance that? Is it for me? Is it a partnership deal? Are we equity sharing with somebody else? Like what works for this deal? Not every deal. They're all deals. Some of them are cheap and some of them are expensive. You're in the Bay Area, you're doing a $700,000 takedown and $1 million exit. Those are completely different than buying a $70,000 house we were selling condos in Vegas for 25 grand. That tells you that there was enough margin in that I made money somehow buying it cheaper than that and selling it. Like you could buy, just like your dad has said more than 100 times, like you could buy condos in Vegas for less than a Honda Civic. Like that was 2010. So
yeah,
the world came back in full cycle. And it was different.
I definitely remember all the calls I got as Invitation, Blackstone, Colony, Waypoint started to operate in these markets. And people are like, these guys are overpaying and it's shutting down the opportunity. And I have to admit, at first, I didn't understand it either.
Neither did I.
And then once I understand that they were buying to rent, and I went, wait a second, right now at these prices, the rent was 10, 12, 15% return on investment.
Yeah.
And I think most of these guys had a target of 7% or better. So they're like bid it up until it's at 7%.
Yeah.
The market's at 12%. I mean, that's all. It's tens of thousands of dollars more, $100,000 more than anybody else in the market would buy to flip it. But their goal wasn't to flip it. And all these auction investors had been buying to flip versus buying to rent. And it was like, once that light bulb went off, I went, wow. And it also told me, I think I wrote a bunch of articles right at that time saying prices are about to go way up.
Yeah. And what year would you say that was? Was that 13, 12 kind of 14 range?
I think started getting the first signs of it in 10, 11, because it was in April of 2010 that I said the foreclosure market's going to come to an end. And I need to start working on broadening beyond foreclosures to all properties and to other things. So that was in April 2010, but our foreclosure business didn't peak until 2013.
Sure. And that was ours. That my 12 was our biggest year. I had created a simple product that was anything in California under 60 grand, I'll buy it. It didn't matter. Like, I don't care how ugly it was or where it was. It was financeable, and the rents would always cover it. And that I had a private money lender that totally agreed. And I would buy 6, 8, 10 of those, put a $600,000 loan on it, get all the money moving back at trustee sale.
And yeah.
Wow. So Invitation Homes came and they're like, oh no, move the combo. Like, we could do $360,000 rentals. And my mind's like, that doesn't make sense right now. Like I'm so much smarter than you, but and it turns out they were right. And they gave me a giant spreadsheet that said, prove this biggest spreadsheet headache thing you're gonna have to do every single night to prove this is correct. And that was the model. The model was, at one point in time, everything that is going to auction today will be worth what it was worth when they did a loan on it. Yeah. So when is that? And so they told me 3 to 5 years. And you better believe I kept looking for articles about, when are we going public? When are we doing this? Like, because in my mind, I thought 3 to 5 years, the whole world would be turned right back on again, be perfect. And I thought people were late to the market. And I could name 100 funds started after 2015 that have $1 billion net worth. The world has shifted, and there is a hoarding effect that are going on to these rentals. And the news feels like it's this percentage of the market, but it's still, this small percent of the rental market. It's people move out of their house and keep it. And they're doing the rental laws in California. I don't know what it is nationally, kind of similar to the fact that people want to be able to keep their home and not be held to the same standard that a large rental fund is held to. Like, it's just about the dollar. Like, when you're doing one rental to one person or one family, it's a different model. It's financed differently. It's creating wealth for families and people and the small investor.
You have so many different interesting things to talk about. I definitely wanted to cover that. I think I want to make sure we spend a lot of time on you, but maybe we can do that by saying, what did you learn at Invitation Homes that you carried over into your own brand?
So, Invitation Homes is like moving the comma twice, if not 3 times. Like, so for the small investor and other, you find your niche, and sometimes you're not working enough on your business to know that your niche is expired. Like, oh, foreclosures are going away. Like, I'm still here at the, why is there no one else at the auction right now? Because there's nothing going to sale. You show up now and there's 10 of us, of which Sean let the secret out. There's only one today. Like, and everybody knows where it is and what's going on and where it's being posted. And I think when I talked to Sean before about this was that you saw some pretty crazy stuff going down in the foreclosure world, and people had different niches and ways to do it. And it's still very, you could be an attorney, cry it at your auction, at an auction at your office if you wanted to be, you know, or the sheriff's office or wherever you want to cry a sale. So the foreclosures kind of went away, and I now classify myself as a distressed real estate investor. And that is across.
You still do that, but you have started seeking other, right? Which is what in April 2010 I said is that's what we're going to need. We're going to need other ways to look for properties.
Yeah, and you were right. Well, and I hope, Aaron, I kind of got off track there. I hope I nailed your question.
No, well, it's interesting to come from that background. You probably saw some things that helped them scale, and you sort of learned on their dime. So what did you learn from that experience and bring over into I Love Houses?
So I would say that inside of the larger institutional model, the fear goes away. When it's your money and it's one deal at a time, you don't worry about where the money's coming from. I mean, I had treasury management to do every night. And when we would lose cashier's checks, which any foreclosure guy understands you do, like I can tell you competitors that have washed them in their pants, you know, like you just washed $400,000. Did you forget you had $400,000 in your pocket?
It's a cashier's check, right? It's not, it's a cashier's check.
And you have to bond out of that. And so at night, I would have to say, you gave me 400 cashier's checks to go to 5 locations at 3 different auction times, you know, and the stack is this big and it's $8 million, you know, like, how did you spend that money today? And then I would have to spend more time. We actually had people that were in treasury management inside of our, like from the bookkeeper side, we had a local CFO, you know, and then it goes to national, the brand shifts and it's significantly different. So, wow. When you're a dude doing a deal and one deal at a time or 4 1/4 or other, you learn like, what is my buy box? How do I live within that buy box, still find stuff, manage the cost of money, you know, because that becomes super relative. And when I was at Invitation Homes, people would call you. They would read an article about you and say, you guys want to buy my house? And so we had a sheet. And then people will call Blackstone. People will call Black Rock because they didn't know the difference between Black Rock and Blackstone. And Blackstone, and they were like, well, how do we capitalize on this? And maybe they funded, you know, Colony or other, but I don't know where their money came from. But it's a completely different mindset when you don't have that fear factor. I mean, our fear, you know, my buddy Dan and I, we would get there and we would have to have the money out by 4:45. In order to get a drive list in the morning to the Bay Area, and you can get Solano County still in time. We can get the money back to San Joaquin County, and we would just be rotating the bodies. And we had a phrase called, we say, buy, don't buy that. You know, it's like this whole, like this vague, you know, you feel like they're going to hold it against you for what you're going to buy. Like your job will be judged based off of that success or that failure. Because we were going so fast. So in October of 12, we had a day where we bought over 40 houses in one day, you know, and you're like, okay, so let's, you know, we have people that change the locks and then you have vacant houses. Now we're so afraid of the world, writing an article about how we're mismanaging our houses that we've now owned for 72 hours, you know, like it was vacant for 7 years or 4 years, you know, and
right.
So it was a different model. And I look at how the rent is bonkers here in Sacramento right now. And we're getting a giant Bay Area effect, which goes all the way up into the Tahoe region of people affecting the prices and the rents and the other. And Invitation Homes said, it's going to be worth this much someday, and it'll rent for this much someday. And when you see that on a spreadsheet times 1,000, it's not relative to anything you and I will do. You never think about borrowing $1 billion against your portfolio, you know, so it's not relative when you're looking at it. And they hire analysts, right? And that's the approach. As if you had a person good enough that they can go out there and flip 12 houses at a time, they're not going to be an analyst for $40,000, you know, so that's why the model matured and you got a lot of good people, and then actually the salary started going up too. So to get a great acquisitions guy and to get someone that it's totally worth their while, that when they turn off their phone at 5 o'clock, like it's off, it's a standard HR. By the time I left, I had 90 employees, and they basically said, you got to have maybe 75 by the time you were gone. And because you build up to deal with problems, you have, much like multifamily, you have a person dedicated to HOAs and dedicated to, the taxes and the issues of code enforcement and go along with it and others. So it was way different and way better.
You worked on the management side, not just the acquisition side. You actually managed them and rented them and did the property management side too.
Yeah. And I would have to get into the dirty evictions, and and so people would come in and be very upset about, you name it, bugs in the rentals, and it would surface up to, like a surface level of, I had to get involved. At the same time, I'm on, 2-hour conference calls to New York or 2-hour conference calls to Dallas, our home office, and trying to deal with everything comes up with being a property manager, the responsibilities of spending, millions of bucks and trying to find product. And that was, can you get enough? How do you incentivize people on MLS? How do you manage people bringing you stuff direct, and the conflict of, not being your own broker yet, and how do you lease stuff? And it was really interesting. It still is. All of those companies, I think, have appreciation to run. I think they're going to hit a real issue with their yield targets. They can't keep buying forever. That's why build to rent is just blowing up. But
right.
So
you mentioned earlier it was buy, and then don't buy.
Don't buy that. Don't buy that house. Like, you can't buy it.
You have a story you've shared there with me before. I don't know if you're willing to share it. One that you bought and it got you branded a little.
Yeah. So there's a very reasonable amount of ego that goes into the auctions. And Sean had mentioned a guy that almost had it's like the gamble, right? Some people look at it as an investment, and some people just really love the chase and the deal. And, trustee sales are a riot for that, because if you go the extra mile, if you're following 20 sales versus 200 and you door knock everything, they're vacant and other people don't, or the people in there have already broken every fixture in there or other, you can kind of make a lot more educated decisions as you go.
You got to put your big person pants on, and it feels like gambling down there. Yes.
It does. And people, so the very first week we did this, it was the best week for us because nobody knew it was me. I didn't tell anybody. And they're like, Christy, somebody came to the auction day, bought 7 houses. I'm like, that is rude. Those people are rude. They need to not come here. And that's me. I just bought those. So if you didn't notice, the mailing address on every single one of those is the same. Like, I still get mail for our California entities here, and I just forward it over. But so I bought, there were just guys in the Bay Area were running us up just because they knew we would probably just keep buying. They felt like if I overpaid, I would leave.
You'd go away.
Yeah. Like, it's just numbers on the spreadsheet. They don't understand that. Like, it's a 3-bedroom, 2-bath, 1,300 square feet, and you're paying $330,000 for it. Like, and in our world, it's a $550,000 house. It's not worth $330,000. You think it's worth $330,000 because you're looking at the next 90 days standard flip model. You're looking at
the cap rate and going, it's worth $550,000.
It's worth $550,000. Like, it should never be worth $330,000. Like, people are gainfully employed in the Bay Area. There are jobs, and there's a shortage of housing, and it's impossible to develop. So, and we weren't looking at it as $550,000, but we just knew I could pay 107% of its value and not offend our model. It won't be a problem at all, as long as I could stay within, can I pay the mortgage, the yield? And so one of the guys was running us up, and he was bidding on a 50-acre single family in Solano County. So I ran him up and I bought it. I bought a single family on 55 acres. And I want to say, like, and the rents were high. The purchase price was low. It was very reasonably close to developable land.
But we always heard about imitation, right? Like, it has to be like a 3-2 single story, like trying to keep that really tight buy box. Yeah. This is way outside of that buy box.
This is way outside of the buy box. So So we had regional guys. Some of them were the founders, and these guys would show up and they just need to say, hey, I was in their region, great people, great organization. They're hiring well, they're building this model well. That was their job. And
well-run company.
And we would audit the purchases. Like, you can't buy this, you can't buy this product. That was always the look you're expecting. Well, when they found out about a 55 acre ranch, home, they didn't give me crap about it at first. They were like, you can't buy that. It was just simple. Then they moved on to the next issue we were dealing with. But when I went out to Dallas one time, one of the guys gave me a cowboy hat. And so I was like the rancher now. Like, and in my world, I'm like, these guys are running us up. Like, I'm from just not like a back off, but like I can buy whatever I want. So we bought a 4,500 square foot rental here in town. And those guys were like, well, it's not in your buy box. Like, what's my buy box? Like, I have $5 million in an envelope. You tell me about my buy box.
Why did you decide to end up leaving?
It was perfectly timed. I was buying and then property management when you plateau. And so if I wanted to stay, they would have found anybody who wanted. There's still Atlanta's still there. Alicia is still there in Atlanta. And she took on, I just saw an Invitation Homes blurb that she's now got a national role. And I was second to go. I want to say Vegas was first. They timed out, they had a very tight buy box, maybe only 1,200 houses there total. And like, for instance, Tampa and Orlando. And they were still buying and we weren't. Like, it's just the mortgage cycle was different than the trustee sale cycle. So we got a new COO and she said, your wife's pregnant? And I said, yeah. So when's she due? And I said, October 15th. And she says, okay, I'm going to exit you on the 17th. And so my 5-year vesting, I got to shave almost 3 years off of it, still get all the upside, but majority of all the upside there. And she just knew they were converting to a property management company now. They still are an acquisitions company, but it could be run national and the volume wasn't there to support my salary and bonus structure.
So after your exit, did you immediately launch I Love Houses?
You know what? I did, but I didn't do anything with it. I launched it. I took 3 months off to be a dad and just try and figure out what I was going to do, because I had a major identity crisis. Like, I've just reached a level of success in a growing region. And like, I could apply that. I could jump on. I think Blackstone was launching a single family rental loan business at that time. And they were, there was
well.
Yeah. And
Yes,
each of them, I remember, kind of looking at Open Door thinking, you guys are late to the model. You guys are late. And then of course they're a technology company that's growing like crazy. And I want to say they got like a multi-billion-dollar valuation recently. And much like, I don't know everything in the world. I didn't see
your skills. So they're a perfect fit for going out and helping acquire homes and getting them through that process and the rest, right? Like so for sure.
So I didn't know what I was going to do.
Lots of places to play.
I still didn't know. I still don't know. Like, I guess it's I get the shiny object thing going, but doing it in volume was really fun. It's just, but buying a single family house, you can decide whether you keep it for the rest of your life or you fix and flip it or other and being self-employed and, kind of controlling your time and being a dad with young kids. I felt like getting back into, the 65, 70 hour week of trying to build something bigger was not a good fit after doing that. My wife gave me X amount of grace. I think I had used up all my husband points at that point in time. So.
Well, kudos to you. I mean, it's not always an easy transition to go from trustee sale buyers, and in my experience are very different from sort of what you've gotten into, going after equity sellers, things like that. So can you talk a little bit about who you're targeting these days and how?
Yeah, great point. Recently I found that, being in, I think it's my 18th year, or so doing it. So I've got a lot of great relationships, and the biggest difference for me and what we're targeting now is some regions are actually getting far better yields for us, like Tampa and Orlando, and places where we could partner with people, or we can get reasonable product and just work off of previous relationships we had built, to move and do the same thing in other markets, but get the necessary yields we need, or more the velocity of, because you could turn a house in 6 months and have a day job and do 2 deals a year and make a great living, a great income, out of that. And our volume right now for what we're targeting with the digital ad spend and the Google AdWords, and creating that funnel, is a bit more about spending money on building the funnel, less on buying sell your house as is, or less on buying the words about sell your house faster. I mean, everybody's looking at how you diversify yourself from it, but if you know your threshold of what you can spend and what you can manage, currently the constrictions on our market are, do you have the staff? Do you have a contractor that will allow you to do an extra 10 deals a year? Like, do you have the finance, behind you, backing you, that you can afford to do that? Are you able to? So we target, right now, we're just targeting having houses at all. Things that we would usually call a $50,000 flip. If you have something available and the market tells you they're not willing to pay you what you think it's worth as is, you can always flip it. So we target just wholesale stuff that's coming through. A lot of people are able to make a buck off of bringing us a transaction, bringing us a deal, pre-market stuff. We've put out some most recent free stuff, Facebook ads and other, the people that you just post what you're looking for. And people say, hey, I have a client looking in the following zip code in Simi Valley, or, whatever it is. You can actually make money looking at wholesale deals differently because they have a client that's going to take it off your hands, or, the yields start to compress to a point where you have that fear kind of kicks back in. But this market is very forgiving right now. Like, you don't have
prices are going up, plenty of buyers. And so it's kind of hard to make a mistake. You're not catching a falling knife like
Correct.
you can in other markets like 2006, 2007. So it sounds like that's an interesting idea there of like finding, because there's so little inventory on the market, right? There's quite a few buyers.
Yeah.
For those, I mean, you're great at finding off-market deals, right?
Yeah.
That's what you've found thousands and bought thousands of deals that were not on the MLS. And so by knowing what people are looking for, by having those buyers, you can go out and look specifically for that.
Yep.
Fill that gap and make something in between.
And the agents do too. The agents are
very fast.
The agents are such a big part of that. Agents and brokers who know exactly what they're looking for. You don't have to explain to them the dynamics of the market, or the buyers that are really just uncomfortable with losing. And I think that politically it will change. I think that the key here is liquidity and lending. If for some reason the FHA flip changes deals, like, do I want to wait 90 plus days to close this house when I can sell it right now? Like, there's a big, that actually matters inside the mortgage industry too. So that's how the 3% down conventional came about.
FHA buyers. FHA has a rule that they won't fund a property that was purchased less than 90 days ago. They basically, it's kind of an anti-flip rule, because they're worried about flippers making money, I guess, or trying to defraud the FHA. But I think it's a ridiculous rule in a market that's moving quick, and in a world where folks go out and find hoarder homes and other things that FHA wouldn't finance anyways, and then they go clean them up and get them to a point where FHA can actually finance them because they're now cleaned up and title issues are fixed. Why does it matter? Why is 90 days suddenly some magic anti-fraud number? I don't know.
Yep. And then so you take a buyer and you trace them through the model. Okay, well, you can't go FHA. You're not a vet, can't go VA. Now, you don't have the down payment. And then there's that, it's like, it becomes, they were incentivizing people with paying you $6,000 for 6% of a purchase price. when that goes away, there's this huge fear, like, oh no, like without the buyers, no one's going to buy houses from us if they don't get a free 6% tax write-off or credit. And so the financing hasn't matched the emotion of the market and kind of where this stuff is going. And HOAs will squash deals because you have to get into stuff and you have to be pre-approved by the HOA. There's a lot of weird filters that go into who gets to buy these things. But for right now, if you understand how you're buying it or how you're going to exit out of it, we're taking really tight deals right now that are not penciling tight. Like, we are making great money on them because the market's giving us gifts, but it has nothing to do with us. We know the product. It's a 4.2 single story, 1,600 square foot house on a court. But when the market is flying, it could be on the busiest street. The fourth bedroom's upstairs and it's at a 7-foot ceiling, and people are like, I'll take it. Like, it's got 4 bedrooms. Like, I want that house. That's my dream house. Like, and suddenly the market's making investors feel like we are the best investor. I'm the best flipper that's ever lived before. Like, that's not.
Which markets are you working in right now?
I would say, so we have 35-ish flips going right now. So that includes stabilization of rentals. I started buying in Memphis and Arkansas and Tulsa, places where I found people that wanted to work with us. They just said, I got the contractor based on this. If you're buying rentals, or if I got, we can flip stuff together, or other, like when we kind of vet it out, and you use a Evernote or WhatsApp or whatever to communicate, send photos, and have a great process. It brings it tight. Like, a lot of people get worried about buying out of state, and you can't drive by it, so I'm probably stabilizing maybe another 10 rentals out of state right now. That's Tallahassee, Tulsa, Memphis, and all the supporting communities into Arkansas that are surrounding Memphis. And I love that stuff. And then I have maybe a dozen full-time flips, and flips are at any given stage, waiting for occupancy, in rehab, pending sale, inside of California. And then we have some in Missouri and Florida and Texas. But actively, at least 20 of those are in California right now, from San Joaquin up to, Northern Butte County.
Yeah, it's interesting. We see so many folks like yourself that have gone and said, I'm going to expand and go to other places besides California because the model that they were using wasn't working. And then you see folks like Aaron Mazzrillo, who we've had on the show, who I saw a post from him on Facebook this morning, is like, I'm now not buying it if I can't drive to it in 5 minutes or something ridiculous. Yeah. Or he's like, oh, he said, if I have to look at a map to see where the city is, I'm not going. Like, I'm not buying it.
But I'll take those scraps. I'll take that stuff. Like, it's a trailer, and it is 90 minutes that way, and it is a windy road, and the fire insurance is really challenging. I'm like, how much is it? Like, I'll take it. Like, and we've got some amazing deals rural, because people are like, I'm not driving all the way out there.
Right. And you're the guy willing to go, and that makes the difference.
Yeah.
Yeah.
And it is, maybe I haven't graduated, let's say Aaron, to that point where I have enough volume that I can eliminate those. But I really like stabilizing stuff like that too. When you get a lower purchase price, it's a whole lot easier to get lending done because you can leave less in the rentals. And I just feel like even the manufactured home industry is not delivering these amazing, affordable products that people would hope they are. By the time you get a foundation underneath it and a porch built on it and attach the AC to it and they're covered, it's like, it's faster, and they have so many benefits they offer in the world. But
there's so much demand, you can't blame them for not taking the cash, right? Like, so the promise was there. I think the promise still is there, that it could be a lot less expensive, but somebody's looking at, okay, I'm going to spend $300 a square foot for site built, right? Oh, but I can get this product over here and I can get it in half the time. Mm-hmm. I'll pay $300 for that. And so if you're that modular builder, right, you're going, yeah, I'll take your $300. It only cost me $100, but sure, let's go.
Yeah, buyers are finding them that way too. They find out that someone else is selling their manufactured home online. The lending laws are different, and there's just so much that goes into just buyers are getting a lot more savvy onto what they're trying to find, and I see a major change, shifting there. That not that we've reached a level. I just think that within inflation and the cost of materials and some of these other things, we have a consistent floor that's going with replacement cost that really won't be changing. And I really like that sub 250 market, because it's $30,000 water
hard
meter.
to get back. It's going to be very hard to get back there for any of that less expensive market. Yeah.
So that's kind of, I found a niche in doing that too.
Before we came on the show, I think you mentioned you're doing land development as well.
So as a distressed real estate investor, you don't really get to choose what you do. You look at it like, I like that deal. I'm going to do that deal. I'm going to buy this house, put an ADU in the backyard, and I'm going to sell it. Or I'm going to split off a lot and keep the lot. Or, I have a trailer park that we bought at sale. I'm not a trailer park manager by any means, but I love it. I love the park. I love the rents. I got a FEMA lease on it, So when the land came through, we do tax sales too. And it was perfect. It's an L-shaped lot, and the property next door was boarded up. So if I could acquire that, I'd get more density. It was a reasonable, purchase price. And I really have the opportunity now to exit out of stuff I bought for 30 grand, 1031 into something better. And it's a perfect opportunity to kind of build to rent. But if I can't afford it, I can at least build the pie, cook it, and sell the slices and keep my own little slice of that. And that's how I see the development play is, I'm not going to be competing with a $5 million piece of land for the builders, but I can bring 4, 6, 8 fourplexes to market. And there are people who will take that scheduled rent, get a simple Fannie Freddie, loan on there, and get a brand new rental. And I, it's easy to be part of that when you understand the cost associated with it, when you have a team you've built that'll help you make an educated decision.
And I think coming almost back to Invitation Homes, I think this is one of the things that I think so many people missed back then and probably still miss today, right? And I think to some degree, the politicians miss this too, right? Around why are these folks are coming in and stealing the opportunity for home ownership and the rest. And it really is kind of a simple equation, right? So if you built a business and you owned your building, right? And then you retire, you're 70 years old, 65 years old, you retire, you sell the business, the people don't want the building, right? You sell the building and you just want something that is super easy. And, if you get a 4% return
warranty
on that money, it's probably, my mom just sold some property and I did an analysis, not on her purchase price, because it was forever ago, but on the current market value, she had a 1% return. And I took that property and sold it and put her in a new property that's a 5% return, but it's a no-brainer, whatever. It's 5 times the income for her.
Yeah.
Right. And people go, oh, I'd never pay a 5 cap. And you're not understanding where this other person's coming from. Yeah. And so if you can recognize, but there's the issue there is they want it to be perfect. They don't want to they can't rehab. My mom's, 84. She's not rehabbing a property, right? She's not doing anything. I could do it for her maybe, but I'm busy. I don't have time to do that either. I just want to buy something perfect, done, easy, tenants in place, turnkey, ready to go, turnkey, right? For her. And that, if you look for those things, that's a big opportunity. And that's what I keep hearing from you, right? Is you're seeing these gaps.
Yeah.
And when you find those gaps, whether it's right now, these buyers that can't find anything, well, let me go find something that maybe they couldn't buy because it's not financeable until it's cleaned up, or this issue's taken care of, or this title thing's taken care of.
And it's not a level playing field, because if you look when Florida kept running on on auctions, California, we were done.
Right.
There was just not the volume there. And now the mortgage states needed 18 months to catch up to that. So when you look at the jobs going to Huntsville, Alabama, and you see conforming multifamily there, which that's my free tip of the world, is I love Huntsville, Alabama. You look at these fourplexes that were built as fourplexes and you're like, oh yeah, that here is 800K. That product there is still 325, and then is a scheduled rate of return. And you look at it from the cost segregation study that you're going to do on that, and get a giant offset of your taxes up front, a bonus depreciation. It's different than your mom's like bonus anything. I got a 10-year warranty on a brand new fourplex. I look at it as I'm going to take I'm taking a existing product and I'm playing a cost. I'm actually adding value to my personal income taxes by doing a cost segregation study. And I buy a new rental and I upgrade out of a single family in a reasonable area. And now I got a 4-family multi-unit delivering return. And you get the tax abatement that comes along with the cost segregation strategy.
Yep.
How do you scale? I mean, you do so many different kinds of properties all over the country. How do you scale something like that? You're doing some volume.
It's transactional. You grow slowly, and some people grow too fast. And I would say in 2008, the people who in my industry who got hurt were the people who had unlimited amounts of money, and it was purely speculative. So I believe that right now, I bought a 4.2 single story this week in Sacramento for $350. I think it's worth $450. So as is, it will rent. I could do, I can get a Fannie Freddie friendly loan on that thing. I have a dual exit on this property. When stuff was worth $500,000 at $500 a square foot, a new build in Somewhereville, and the rents are only $2,000, you don't have that, that luxury. So by scaling up slowly and not taking on unnecessary risk, you remain an investor versus a gambler. Like if you're like, hey, I foresee the jobs are going to come and they're going to come here to California. Like, okay, you see that, right? Oh, and when Tennessee and Texas are doing campaigns to pull our businesses away, it's a supply constrained market we're dealing with here. If you are gainfully employed and you want to do your first rental, your 10th rental, your 5th rental, Fannie and Freddie are like, that's fine. Do you have reserves? And how much are you putting down? It's so simple. Have you hired a property manager to handle that for you? They take all the science out of it. So you buy it. The most motivating model for me right now is the BRRR model, to buy it, rehabilitate it, rent it, refinance, repeat model. The BRRR model, you hear a lot of it on Bigger Pockets and with David and Brandon. And if you can live in that world and do one deal at a time, you're scaling up your rental business. Or if you can get with the realtors, the agents and the brokers and say, this is very specifically what I'm looking for. If I have to look at 25 deals before we make one offer, or make 25 offers before we get one deal, are you willing to work with me on this? And the agents and the brokers will facilitate that growth. And you meet people and you tell them the truth. This is what I love to do. This is how we do this. And people will bring you stuff. So scale is built transactionally unless you are building a business to scale. If your goal is, I got to get to 100 flips, that's a different level of scale. For the relative investor who wants to be an operator inside of this space, do I have the people surrounding me that are going to help me succeed at this? Construction management, the finance side. It is a big part of rehabilitation and cost of money that will affect your business. If it's all your money and the risk is way less, that's not really, something I'm looking at from scaling from that standpoint. But for the people who could do one deal a quarter, or who are gainfully employed that want to do one rental a year or one rental every 6 months or something, and the BRRRR deals, that stuff you build on your current success and you build on your comfort level. Like I'm not buying 100-year-old remodels or restoration projects. We're buying, in Arkansas, we're doing 1990 or newer single family houses, sub $20,000. And they're out there. And people are like, $20,000? Like, did you say $20,000? Like 90 or newer?
Yeah. Wow. one of the things I think a lot of people, especially that go, oh, I want to buy distressed, is they don't understand, on this is a scale issue, they don't understand how many properties they have to look at to buy one, right?
Yeah.
And I used to say when I was in the trustee sale business, I'd look at 50 properties to buy one. Where are you now in that kind of, how many things do you look at to buy something?
The season we're in real estate, it's higher ratios. So I would say in the MLS world, I tore 25 to 50 for one that I get. It is, but it does not mean there are no deals on MLS. That is one of the the objections you hear. People are like, oh, there's no deals on it. Like, there's just stuff that can't be financed or has hair on it, or people just don't understand the dirt value underneath it. There's so much there that if you're looking at it, but that is a grind, right? The KPIs associated.
That's a perfect example though, right? All these people that say there's none of this,
Yep.
right? They're just not understanding the work it takes to find them, right? I mean, that's so awesome. And it's such a thing we deal with every day with folks who are like, I called 2 people and both said they weren't interested. Yeah. I'm like, call me back when you called 50, right?
Yeah. And
Go ahead.
That, so when you buy a house on MLS and you beat the system, right? You were the only guy who got a deal on MLS this year, they think, right? You're fixing it up. Neighbors will come to you. Like, I'm talking a $6 vinyl sign in your front yard that is like this. Hey, we buy houses, and like, people will call that phone number because they're the neighbor. They want to know how much is it going to be sold for? How much did you pay for that? And if you put inside of the data that even Radar gives you, it's like you can find out who all the neighbors are, send them a postcard for 50 cents each and say, just bought this. We paid $350,000 for it as is with a problem tenant, whatever you want the message to be. People will acknowledge that you're doing it. And so you get the ball really starts rolling on, people there in front of you. They want to work with you. They choose to work with you. And the MLS thing is like, it is a grind. The KPIs for advertising in Indianapolis, it's like $1,250 a deal. Like, if you pump $3,000 into advertising, you're going to get either 1 or 2 or 3 very reasonable deals out of that, from what a buddy of mine who's got it seasoned out there is saying. But do you know what a deal is in the first place? You're like, oh, Zillow says it's worth 160. Oh, well, what's it actually worth? Are you working with someone on your team to do that? So we get inside of advertising, it's more like 80 calls, 8 offers, and it gets you 1 to 2 deals. And, the KPIs there for advertising is more like, it's a real win would be $2,500 striking price, per lead that you close on or something. But it's kind of advertising. It's kind of like ranging between $3,500 and $5,000, depending on, are you paying more for advertising based off of who else is buying and when? And that's a real fluctuation of how you do it. But our strike
direct mail, like I found 5,000 to 10,000 pieces per thing per what purchase. What are you seeing there?
Inside of direct mail, I haven't done it in years, but it was very, what I loved. I want to go back there because the digital buyers click on far more websites or other before they find you. The direct mail is, they may have gotten 10 advertisements 10 days in a row, and the one they got that day or other is the one in your hands that speaks to them for whatever reason. They're not shopping for more use. Sometimes some people will set all the mail aside and they'll have 10, they'll look through them and decide which one they want to call. However that happens, I think it's more of a level playing field. There's not like they're actively looking at 10 other people doing exactly what I'm doing. I've really had success with that mail, but we just haven't been doing it in the last couple of years.
How when it comes to the KPIs on the digital marketing side, how important are really good lists, or are you sort of just targeting specific terms that people are searching?
It's really personal to the investor. Ours are distressed. So inside of the data of, if I only did mailings and property drives on NODs, if I'm in that same area, the lists that overlap become really important. Like, do you have a code enforcement, a blight list that you could apply to that? Can you apply the USPS vacancy list to that? It'll ring 3 bells. You could probably surface 30 houses out of a list of 300 that are on all 3 lists. And that becomes the science behind the data is like, how many more can we, like if I only had to look at these 30, like, could I target those personally? Then you have no cost. Can I do those drives or can I pay for those drives? There are companies right now that you can pay for a photo of a house. They'll go in and open it for you. Like, there are rental companies and listing companies that will let you list your home, and you could pay a realtor to show it for you. It's like a $35 fee or something, and someone will go open the door and show it. So you don't have to leave your desk, even if you understand the data better, and you line the data up like that. It just becomes so obvious. You're like, oh man, I had 300 leads. 3 of them, these rang the bell 3 times. There's my focus.
List stacking. Hooray.
Yeah. That's right.
Segmenting, just kidding.
What everybody else calls list stacking, we just call criteria. You just keep adding criteria.
Yeah, just keep adding criteria. And you can eliminate at that point in time, stuff over $600,000. I mean, I have a stellar resume breaking even on flips over 700K. Like, it is not the Bay Area market here in Northern California. Like, at like 700 the last few years, people are like, oh, that's a little pricey. Now, like, our move up market is now like at 700, but you look at something like, oh, it's worth 750. I'm buying it for 450. Well, you put 150 grand into it and carried it for 9 months. Like, the margins just start going, start dying.
Yeah, lots of surprises in the supply chain for doing repairs. Not fun.
Yeah.
We are about out of time. Is there anything you're really excited about this year as far as opportunity?
I think the real game changer for me is tax strategy. I really feel like for people that are getting into why you're buying it, you really can think and differently. People that need the write-off, that are buying their first commercial property, they're getting out of residential into commercial, buying their first rental or other. What you buy really matters, like, and what its price point is and how it cash flows according to the seed you're planting. People really don't see the fact that you can sell that duplex in 5 years and buy 10, 15 units out of state, or other that are cash flowing even higher or better or different. You graduate piece by piece by piece by using the tax strategy for your portfolio. It's much more than one single family rental you own that you get to drive by or other. If you can take the emotion out of it, which I cannot sometimes. Like, I'm like, oh, I bought this thing so cheap and I love the tenants and they have a great dog and your kids are going to the high school, or like, if you can sell something, just like what Sean had mentioned, it's operating at like a 4 cap if you consider what you paid for it or whatever. If you can unlock that $250,000 in equity you have now in a property and have that working for you also, there's really a strategy to doing that every 2 years or 5 years or other. So I'm looking for people that invest in me and other that get the benefits of that when we co-invest, or people that loan us money. Some of the stuff we're doing so well right now is choosing what we're keeping and how and why we're keeping it. And can you tell that story to people that understand it? And tax strategy is something that is just really deep right now, like, for how much of a benefit you can get out of it, that you proactively instead of reactive. Tax strategy is so much different.
Okay. Well, if people would like to reach out to you, where would you like them to go?
Email's best. I mean, my LinkedIn is great, there's not a whole lot of Tommy Christies in the world. I'm not a Jim Smith or anything, but you'll see my shiny face on there with my cute little shirt, or Tommy at ilovehouses.com.
Okay. I will make sure to post all the links. Really appreciate your time today, Tommy.
All right. Thank you, guys.
Thanks, Tommy.
Thank you for listening to the Data Driven Real Estate Podcast. You can find show notes and links to some of the resources mentioned in the show at datadrivenrealestate.com. Click that Join the Community, and you'll be forwarded to the PropertyRadar community, where you can ask questions about the current show and even see upcoming guests and ask questions there. We'd love to engage with you in the community, so check it out. Please don't forget to like, favorite, subscribe, and share on your favorite platform where you're listening to the show. It helps us out a great deal. Thanks for listening, and we'll see you next week.